On today's show, we're going to look at 7-Eleven cap rates, the pros and cons of 7-Eleven triple net deals, as well as take a look at 2 7-Elevens I've sold and some active 7-Elevens for sale. So let's jump in.
Impact, income, return.
I'm Thomas Morgan with 1031 Navigator, Compound Global. My friends call me Timo. If you're listening to this on our podcast, this show is going to include some visuals. So you might want to head over to YouTube and check out the different screen sharing and different brochures and demographics and whatnot we're going to show you. But mainly you'll be able to get a gist of what we're talking about here just by listening to the audio. But if you want to see the visuals, you just can do a search for 1031 Navigator or Compound Global on YouTube, and you'll be able to see those videos. If you're here from 1031navigator.com, you're probably already aware that 7-Elevens are an ideal 1031 replacement property. They're going to allow you, obviously, to defer your taxes from your 1031 exchange, but they're going to provide you with that secure long-term income that most 1031 exchange investors are looking for. And if you're here from Compound Global, you might be asking, what the heck do 7-Elevens have to do with impact investment? And that's probably a whole nother episode which we can cover. But the basic tenets of Compound and our fund are income, impact, and return, and not necessarily in that order. But we believe that everyone has to have an income before they can make an impact or get a return. So 7-Elevens, by providing that secure passive income, hit that first mark with the income, and that's why we're covering it here on Compound Global. And they're also passive, long-term, secure investments, same attributes of why someone would want them for a 1031. So we're going to start off looking at 2 recent 1031s I did into 2 different 7-Elevens, one in the Chicago MSA, the other one in Central Texas. And so let's just jump in. We'll cover each deal individually, and we'll go from there. Basically, the first deal here is a Chicago MSA deal, build to suit, brand new 15-year lease. This was part of a $9 million 1031. This deal itself was only $3.8 million of the $9 million 1031. And we did in O'Reilly Auto Parts in Florida. And then we also did Family Dollar in North Carolina as part of it. And this deal rounded out the 1031. But what we're looking at here is the basic OM or offering memorandum of the deal. This is the basic, business points, kind of the sales brochure that we get from the listing brokers and or the developers that kind of tell us, what's going on with the deal. We're always careful to pull our own demographics and whatnot, which I'll show you in a minute on the Texas deal. But this one, infill location, had a lot of people, high household incomes in the trade area, corner location, busy intersection. Kind of gives you the idea of the other general retailers around. And this one, they actually tore down this office building, office complex, which shows you how much 7-Eleven wanted this location. There was 2 or 3 buildings here on the corner. This is, this email here is part of the due diligence I do for my clients. Kind of look at, okay, what's happening here, and why did 7-Eleven or the developer do this deal? And the developer paid, I think, $1.5 million or $1.8 million, something like that, for this complex to tear it down. And what they built was this. This is the rendering on the deal. And it's nice looking pride of ownership building right on the corner. And this was a build to suit, ground up construction. So my client got a brand new 15-year lease right at the close of escrow. And they were asking a 5 cap on this, 5% cap rate. And we were able to negotiate it down to a 5.16 cap, which was a $122,000 savings. And one reason that we really like this site, besides the high income, besides the long-term lease, besides the tenant credit, was what's called the retail marketplace report. If you look here, this is the 5-minute drive time from the property, and this is the retail gap. And this is data I pull for my clients on basically every deal we do. And we want to see, okay, what businesses could go in this location if the tenant were to ever leave. And one, why did this tenant want the location? And this also plays into how that tenant, or why that tenant would renew in the future at the end of the 15-year leases. If you go here to gas stations, look at this line, this green number is excess supply. So $25 million of excess supply. And if you go down here to the 10-minute drive time, there's starting to be some red numbers, which is oversupply. And you look at gas stations again, another 94 million in the 10-minute drive time that's not being met. And then what's even crazy is normally as you get out, especially in a big area like Chicago, you get out in the 15-minute drive time, all these numbers become red just because there's so much retail and so much development in these big metros, or in smaller areas, not enough population. But you look here, gas stations again, $115 million of unmet demand. So this combined with the household demographics, and these are the demographics I pull, my 10-minute drive time was showing 150,000 people in the trade area, average household income of $101,000. And then we have the age, ethnicity, trends. So the area, Chicago, Midwest, kind of staying steady. So that was maybe one of the downsides of this deal, but all the other metrics checked out, especially this high population income number in the 15-minute drive time. So that's the first deal. So let's jump over to the second deal. This one is in Central Texas, in between Dallas and Austin, which is one of the hottest markets in the country, high growth corridor, high income corridor. This was originally being marketed similar to the Illinois deal, build to suit, 15-year deal, 4.75 cap rate. We kind of went back and forth on price for a while. I think we looked at it in January, didn't end up going under contract on it until probably May, I think. And so this is the original offer memorandum that shows the price. By the time we offered it in May, they dropped the price to a 5 cap, and we ended up getting it under contract at a 5.10 cap. So we got a 35 basis point premium on the cap rate, and basically we're able to buy this deal. Here's an actual photo of it. We were able to buy this deal for $270,000 below the ask price, or the original ask price. The appraisal actually came back at a 5 cap. We bought it for a 5.10 cap. So that was $70,000 that basically we saved on the day my client bought it. And as they say in real estate, that you make your money when you buy. So that was good news that we negotiated, from the original ask price, $270,000 off price. And then we bought it $70,000 better than ask price. And the total price on that, I think just under $3.6 million here. So let's take a look at the deal. Brand new build-to-suit construction. This location compared to the Illinois one, the Illinois was a infill location, and this is a highway location. So Interstate 35, I-35 comes here. So the local traffic counts were not very high. They're 7,300 at the intersection. This is the site right here. But the traffic counts at the interstate were 63,000, which is huge. So this location in comparison to the Illinois, which is infill, a lot of people, density, this is a lot of traffic going back and forth. So we wanted to be really careful about the location. So we took it a step further and we did some more due diligence. Said, okay, what's happening in the area? This is a hotel that we found out that's being built just down the street from the Holiday Inn. And this is a gas station that's actually in an inferior location. The 7-Eleven is actually over here near the exit. And then this gas station right here had 16 pedestals. And so everyone now who exits the interstate is going to have to go by the 7-Eleven if they wanted to go to this gas station. So our theory is that 7-Eleven knew that they're going to capture a lot of that business from that other gas station. And that gas station, while we don't have exact numbers, was probably doing a huge volume and a huge business with having that many pedestals. And this hotel was just on the other side of the gas station. So this deal we kind of evaluated a little differently than the infill location, but same thing as the Illinois one, 15-year built-to-suit, absolute net lease, brand new construction. Here's kind of the location. Here's Dallas. Here's the location, Waco, and then Austin is further south. And here's kind of the surrounding retailers and different attractions and whatnot. And then this is interesting demographic data that a lot of brokers aren't using. It shows where people are coming from to West Texas. They're either traveling to Austin or San Antonio or Temple or Waco or heading up north to Dallas, Fort Worth. And it shows all the different origination points. And basically what this is doing is tracking, the way I understand it, is tracking the cell phone usage of different people, of where they kind of fire up their cell phones, different apps that we're using. They're tracking where we go, essentially. So make sure you watch out for your privacy. Okay, so now that we looked at those two deals, I covered some of the pros and cons in those deals, but let's look at the pros and cons of just 7-Eleven in general. And we're going to go over the cons first. So I think the biggest risk with 7-Eleven is the average price per square foot of both the land and or the building. It's not uncommon in a 7-Eleven deal to pay $800 to even $2,500 a foot for the building. The buildings are usually only 3,000 square feet or so. The acreage is sometimes as low as like a quarter of an acre and maybe up to 2 acres. Kind of an acre is kind of the sweet spot. So you have to be careful when buying a 7-Eleven that you don't overpay based on that per square footage value of what you're getting the income stream, you're getting the security of the lease, but you don't want to overpay based on the residual value of what is there at the end of the lease. You want to make sure you buy in an area that has growing rents, growing population, good household incomes, and that residual value of the land is going to support that value, that what you paid for. If 7-Eleven stays, you're not so worried about the residual value because the income stream will be based on the cap rate later when you go to sell the deal. But if 7-Eleven were to not stay, you want to make sure that the residual value is there. So that's why I take a real close look as to, okay, what are you paying for the land and building, and where do we think residual value will be in 15 years? Another con to look at with 7-Eleven is the canopy and the fuel pumps. It can be a good thing that 7-Eleven removes the pumps and the canopy, but actually it can be a bad thing because then your residual value drops if you wanted to reuse that property as a gas station. If you wanted to reuse it for something else, then it's actually a good thing. One con of 7-Elevens, and this is more of a due diligence thing, you just have to be careful of the historical environmental condition of the property. It's not uncommon for a 7-Eleven to go in on contaminated or previously contaminated lots, and you just have to make sure you review the lease and you'll review the phase 1, phase 2, no further action letters, whatnot, to make sure you as the new landlord don't have any environmental liability going forward. Both these deals that I just showed you actually had clean environmentals. The one in West Texas was virgin ground, and the one in Illinois was a scrape, but it didn't have any previous environmental concerns. So a con of 7-Elevens is some of the deals are advertised, they look really nice on the surface, like these ones we've looked at, but then you get into due diligence and you realize that they have some kind of monitoring well, or they have vapor barrier or whatnot, and you have to be careful because that one could tank your 1031 if you decide you don't want to buy the property and you're already past your 1031 ID deadline. And under the 7-Eleven lease, you can be responsible for previous environmental conditions. So you have to make sure you have your attorney review that and look carefully. This one is not really a con because it's just kind of how the business works in terms of like corporate entities. But 7-Eleven, which is very similar to the way Firestone is set up, Firestone is owned by Bridgestone, and then 7-Eleven is owned by a big Japanese corporation. 7-Eleven and Firestone are both traded on the Japanese stock exchange, and then they have wholly owned subsidiaries in the U.S. So you're getting, at the end of the day, you're getting the public credit of what's traded on the Japanese stock exchange, but it is in an entity in the U.S. And the good thing is, like Bridgestone or Firestone, to my knowledge, all their locations are included in that entity. So you don't have to worry too much about bankruptcy or whatnot, because they're not just going to put 10 stores or 50 stores into bankruptcy. They'd have to actually put everything into bankruptcy. All right. As for the pros, I wouldn't be doing a video about 7-Elevens if there weren't a lot of pros. But basically, most 7-Elevens are absolute net. It means no landlord responsibilities, mailbox money, passive income. Tenant credit, if you're buying a corporate 7-Eleven, is the A-rated S&P, Standard & Poor rated credit tenant. You got to be careful. You don't want to buy a franchisee 7-Eleven, which there are those deals out there. Cap rate on a franchisee should be way higher than one of these deals we're talking about. But we're talking about corporately guaranteed S&P rated credit tenant. So you have peace of mind, security from your income stream. Most of them are 15-year build-to-suit construction. Build-to-suit means 7-Eleven really wanted the location, and they worked with their preferred developer to go into the market and figure out where they want it to be, buy that land, sign that lease, build the building, and then 7-Eleven is able to open up there without expending their capital on the development. Preferred developer does it. Preferred developer then sells it to clients and investors that I work with. Another nice thing about 7-Elevens is the residual value of the real estate. 7-Elevens are typically infill locations or just the nature of the business. They have to be super busy, a lot of people, a lot of cars, a lot of foot traffic, whatnot. So the locations are going to tend to be in very dense or very busy locations, which to me, that helps in the future. At the end of the 15 years, you're going to have a good piece of solid real estate. So a lot of investors are okay paying $2.5 million, $3 million, $5 million, $6 million for these really dense, scarce real estate locations. And while you own the property, while 7-Eleven's in there, you get the things we just mentioned, the 15-year absolute net lease, the tenant credit, the security, peace of mind, whatnot. Cap rates with 7-Eleven are in line with other triple net investments, Firestones, Dollar Generals, Walgreens, CVS. They're not down like McDonald's, like at 3.5, or Chick-fil-A at 4, 4.5 cap, things like that. 7-Elevens are actually a reasonable cap rate and provide all those same benefits. I'm not an attorney, but I've read the indemnification clause in the 7-Eleven leases, talked to a bunch of attorneys about it, and from what we see is 7-Eleven has a very strong indemnification clause for the landlord. So if 7-Eleven pollutes the property, then they have to clean it up, and them with their strong credit rating helps you sleep well at night because you don't have to worry about environmental issues. Another benefit of the 7-Eleven lease is that it has built-in increases both in the primary term and in the options. Walgreens, CVS, Dollar General, things like that are going to be flat leases, where 7-Eleven every 5 years is going to have a 5%, 7.5%, or even a 10% bump, and that goes in the primary term, so 5, 10, 15, and then in the options as well, and they typically have 5-year options. 7-Elevens are super easy to finance. We can get non-recourse or partial recourse financing. You don't have to sign personally, and lenders will fight over it. These two deals that I did, just showed you, had very small loans on them. I think we were in the mid threes, like 3.5%, something like that, on a over 5% cap rate. So my clients were all making 2.5% on the spread. 7-Elevens are easy to gauge the demand, like those reports we looked at with the retail demand, the population. You kind of see what else would go in the location. So that's a nice benefit of buying an established market segment like gas stations or convenience stores, is there's a line item and we can see what the demand is in the local area. And 7-Elevens are Mailbox Money. The rent shows up on the first of the month, auto deposit if that's the way you want it, and you get an email and it gets deposited to your bank account. And one of the last pros that's become super important here during the age of COVID is it an essential business? And yes, 7-Eleven is an essential business. So similar to CVS, Walgreens, Dollar General, hardware stores, medical office, things like that, 7-Eleven is an essential business. When we were doing those two deals, we just looked at, it was during COVID. Neither of them had any hiccups because 7-Eleven actually was adding 20,000 jobs during the pandemic. So 7-Eleven stayed open. They were considered essential. Gas traffic was probably down, obviously, but they didn't get hurt like the drive-through restaurants, coffee shops, sit-down restaurants, things like that. Okay, so now we're going to look at some active 7-Elevens for sale and some recent solds in addition to the two that I just went over in detail. Here's just a few that recently sold. You can kind of see the price points, 5.5 million, 2 million, 5.5, 5.3, 2.2. The 7-Elevens kind of have a standard prototype. Something to look at is, the condition of the building, or, how nice the building is here. Like this building looks to be a little older. This building looks to be a little newer. So those are some solds. Here's a few more 7-Eleven solds. And of course, if you dug in deeper on all these, you could get to the brochure, kind of look at the aerial and look at the area. Something I do for all my clients is pull those demographics, pull the crime report. We'll actually go back. Here's a crime report. This one's the example on the Texas one. The total crime index is 50. A big city like LA might be like 400, or New York might be like 500. So what I always look for is these super low crime indexes, and that kind of gives you an idea as to whether or not, if and when you visit the property, that you'll feel safe and you'll want to get out of the car. I've seen people get surprised before when they think they're buying something, they look at the fancy brochure or whatnot, but they didn't check the crime rating. And that's why I always check it. And they go there and they're like, gee whiz, I don't want to buy property in this area. So the crime rating is important to look at. But on all these solds, that's something I do for all my clients, is look at the demographics, the traffic, the crime and whatnot, to make sure that all these deals that look the same on the surface are really, what's the creme de la creme of those deals. So here we're going to look at the sold data about the last year. This is just one of my data services. I have 3 or 4 other databases I can use to get 7-Eleven data, but this shows the dates sold, term remaining, because the cap rate is going to fluctuate. Term remaining is important because a shorter term deal should sell for a much higher cap rate than a longer term deal. Here's the square footage. Most of them range from 3,000 or maybe 2,500 square foot to 3,500 square foot. Here's the acreages we talked about. Selling price. So basically, here's the averages on all these deals. 3,200 square foot square footage, about an acre of land, a 3.8 million price. Some of the deals are up in the 5 million. Some of them are lower, obviously. And here's that kind of price per square foot thing we looked at. The average price is 1,200 or almost 1,300 a square foot, but here's some at 500, 700. But then here's a couple at 2,400, 2,100. So those you have to be careful about. Where are those locations? This one's in California, so I would expect the price to be higher. They're going to pay higher rent. The real estate costs are higher. The values are higher. More people, whatnot. So it makes sense. This one in Virginia, I think, was outside of Washington, D.C., which again, the prices are a lot higher. Real estate values are a lot higher. Whereas something, this one in Colorado might have been more of a rural deal, but it's actually a ground lease also. You're not actually getting the building with that. So that's why that one is a lower price point. This one in Wisconsin could be more of a rural location, so only $700 a foot. And the same with South Carolina. This one could be more of a rural location as well, but still sold for a pretty low cap rate. Average asking cap rate on these deals was 4.88%. Average closing cap rate was about a 5 cap. So that really depends on the location as to what cap rate it's going to close, and then the lease term is going to make a difference on what cap rate it closes at. But basically, here's the spread, the basis point spread. So they're getting about 15 basis points from ask to closing cap rate. So that's about normal. I always tell people there's usually at least 5, 10, 15 basis points of price in these deals. And it really depends on what they're asking for initially. If they're asking, this one's kind of crazy, but that's again California. If they're asking a 4.3 cap. Most of my clients wouldn't pay that, but several investors are willing to buy it at a 4.39 cap. All right, so here we're going to look at some 7-Elevens that are actually on the market for sale. And if you're in the market for 7-Elevens, go ahead and give me a call or text me. I'd be happy to help you out. 970-618-4086. Fit that in there. Here's a few 7-Elevens that are currently for sale. I have other data services I can use. I can also get off-market and pre-market deals from different developer clients I work with. Or I can contact my broker buddies, who I really value my broker relationships with people, and I can get another 10, 15, 20 deals even before they even go on the market. And you can basically privately look at deals and not have to go on to the different public data services and try and scrape through all those, see what's available and whatnot. So that's one of the other advantages of working with me and how I help people, is sourcing those off-market deals. But here's Illinois, Texas, Florida, again, remaining term. These are all brand new, built to suit, 15-year deals. Square footage is all within the range. This one's a little bigger, might be a highway location, more of a kind of a truck stop type deal. Price per square foot, $1,500 or $1,600 a square foot. So on the solds, they sold for an average of about $1,300 a foot, and the average ask price is around $1,600 a foot. So that's that bid-ask gap, where if you negotiate these down from a 4.8 cap on average to about a 5 cap, then all of a sudden you're in that 1,300 square foot range. Average price, most of these new ones, they're obviously paying a lot of rent. Really depends on the location, but Texas, New York, Florida, Illinois, those are all probably super high density locations, high income, high traffic, whatnot. So that's why the high land values, that's why the prices are higher, because they set the rent based on what the cost of the land and development are, but they also set the rent based on what they think they're going to do. They need to make sure they can afford the rent. This is one of the main reasons why going back to the con on the pros and cons list of why you have to look. Okay, what is this property, this $5.6 million property going to be worth at the end of the 15-year lease? So we would have to dig into that Florida location, look at the demographics, look at the traffic, whatnot, and kind of make that judgment call. Okay, we got 15 years of $268,000 plus the increase at year 5, the increase at year 10. Okay, how much money do we get out of our investment, and what are we going to be left with? And then it also goes back to, do we think 7-Eleven will renew and stay there? Because if 7-Eleven renews, then you're just getting your rate of return, it's a passive income investment, and that residual value doesn't matter so much. But if 7-Eleven were to leave, you want to look at that residual value and say, okay, what would that be worth at the end of the day? Kind of calculate that into your investment pro forma. So there's some examples of deals I've recently sold. If you have questions, let me know. You can hit me up on text or email or any of the websites. If you go over to 1031navigator.com, if you haven't been there, we have a section where you can ask a free question. I can put it on the podcast if you want. You can call, you can video it in, you can text it in. We also offer free 1031 consultations. I only do it once or twice a month, so I don't have too many spots left, but you can do that at the website. And then obviously you can check out the videos and the podcasts over there at 1031navigator.com if you're in a 1031 and looking to do a passive income investment. And if you're looking to do more of an impact investment or triple bottom line investment, that investments that make financial return but also do something good for the environment and or the people, employees, stakeholders, whatnot, then check out compound.global. You can get a private invite, different investments we're working on, or early access to our fund, which we're also working on, which is basically an impact investment fund that's focused on income, impact, and return. And also we have a spot on Compound Global where you can call in, be on the show if you want to ask another question about 1031 exchanges, about impact investments, money, legacy, whatnot, compound.global/talk. And you can send a video or an audio or a text, and that would be on the YouTube or it would be on our podcast, Net Present Value. Would love to hear from you. Leave some comments down below. And if you like this video, obviously, please thumbs up it. And you can reach out to me personally by any of these means here on the 2 different websites, or I'll give you my personal cell phone number, 970-618-4086. Text me, call me, whatnot. Would love to hear from you. Thanks for watching, listening, and looking forward to speaking with you soon.